This week's number, 6. That's the number of people who showed up to the EU's $400,000 party in the metaverse. What should the EU have done? Given Hunter Biden a ticket to Vegas and 390 grand, and just see how things unfolded. Welcome to Prop G Markets. Today, we're discussing Robinhood's retirement accounts and a lightning round featuring our colleague Aswath Damodaran. Aswath is perhaps one of the clearest blue flame thinkers we know. You'll hear his thoughts on Apple and Amazon's valuations, the Chinese markets, and where to look for investment opportunities, and more. Here with the news is Prof G media analyst Ed Elson. Ed, how are you?
I'm great. How are you feeling after your big day yesterday?
My big day? You mean my colonoscopy? That's right. So I asked Dr. Joseph, my gastroenterologist, my gastro, that's what they call them, I guess. I went in, nurses all around, they're giving me the Michael Jackson drug, and for the first time I felt like I empathized with Michael Jackson, like I sort of understood him just for a brief moment. He used that drug, I think it's called Prof.
I don't like where this is going.
He used that drug every night for 11 years to sleep, and I could actually see doing it. It is a really good sleep. But before I nodded off into Never Never Land with Michael Jackson, I said to him, before you enter me, will you scream, "Surrender, Dorothy," and pull my hair back? And there was a pause, and then they all busted out laughing. I am a huge hit at Liberty Gastroenterology. So anyways, they love me there. But anyways.
Nice. How many of those tweets were you like drugged up on yesterday?
Definitely one of them.
There was one video where you were definitely high.
Definitely one of them.
I could tell.
How good do I feel? How good? I got apple juice, I got pretzels. Get this done. But my offer stands. I've said anyone who schedules a colonoscopy and copies me, or tags me on Twitter, I will donate $250 to Charity Water. At the end of the year, I try and raise some money for them, or I try and come up with an interesting way to virtue signal and give money to Charity Water. So $250 if you schedule a colonoscopy and tag me on Twitter. This is, unfortunately, it's the third leading cause of cancer death. Who knew Eartha Kitt died of colon cancer? But anyways, that's the bad news. The good news is, Ed, is it's entirely preventable. So when you're 50 in about 35 years, all you need to do is go and get a colonoscopy. And what they do is they go in with a camera and they find these polyps. They grow very slowly but can become cancerous, and they just go in and snip them, so no muss, no fuss. But it's a very curable form of cancer, and we have this fantastic preventive measure called colonoscopies. Anyways, I'm a big fan of these things.
Good to know. Looking forward to it.
There you go. Another reason to get older.
Sounds
all right,
fun.
what's going on with the markets?
Let's start with our weekly review of market vitals. The S&P 500 declined through most of the week. The dollar fell against other major currencies. Bitcoin was relatively flat at around $17,000. And the yield on 10-year treasuries continued to fall. Shifting to the headlines. London became the world's biggest centre for fintech investment this year after receiving $9.5 billion in fintech venture capital. That was more than New York and San Francisco. Coinbase CEO Brian Armstrong said the company's revenue will be cut in half this year. The crypto exchange continues to struggle with the collapse of FTX and falling trading activity. The price of oil reached its lowest level this year at less than $75 a barrel, erasing much of 2022's gains. Russia's invasion of Ukraine briefly sent oil prices up to $140 a barrel in March. China announced a rollback on its zero COVID policy, loosening some restrictions such as mass testing and mandatory quarantines after the approach prompted protests across the country. And finally, the Trump Organization was found guilty on 17 counts of criminal tax fraud and falsifying business records. At issue was the company's practice of paying for employees' personal expenses, including apartment rentals, car leases, and even private school tuition for their children. Trump himself was not charged, but the Manhattan District Attorney says the investigation is ongoing. Scott, what is actually illegal about paying for employee expenses here?
Well, there's nothing illegal as long as they're related to work. And a lot of small businesses do this. You can basically justify the majority of your expenses especially if you're an entrepreneur, especially if you're in the services business, is being related to work. You go to dinner and someone at that dinner is a potential client at some point in the future, or perhaps has referred a client. Is that a business expense? You travel to London and you meet with several potential investors, but you also spend time there just enjoying London. Is that a business expense? It's pretty squishy, and one of the advantages of having a small business or having your own business, quite frankly, is that you just get to expense a lot. It brings up a host of issues. Specifically, the IRS is underfunded, and it's very difficult to enforce regulations unless they're making a statement. When they went after Kim Kardashian for her endorsement of a cryptocurrency, there's probably a lot of people that have done something similar, but they wanted it to send a signal, so they go after high-profile people to create algebra of deterrence. But one of the advantages of having your own business, or especially a small business, is that you can write off a lot. But I see this as very political. I'm glad it happened because I think former President Donald Trump is a stain on the fabric of America that'll take decades to starch out. What are your thoughts, Ed?
I was just going to push back. Tuition. That seems, I mean, you're talking about a gray, squishy line here. That seems way over the gray, squishy line.
I think you're probably right. But yeah, tuition for someone's kid seems that does seem over the line. But I'm sure there are laws around all of this. And I'm sure he's guilty. The issue is there are probably a lot of businesses that really are very aggressive around what they expense, and the IRS is underfunded and isn't able to go after that many people. But you can be clear, there's so many people who can't stand this man, and he has pissed off so many of the wrong people that they're going to, people are going to attempt to enforce our laws. Where they don't get enforced is that everyone will go to jail except him. I mean, Michael Cohen went to prison. What was Michael Cohen doing? He was doing the president's bidding. He will not go to prison for any of this. Donald Trump is like Elon Musk. There's going to be a series of people who look back and think it was a bad idea to be in this guy's, have proximity to this person.
Okay, let's move on to our first story. For the first time, the commission-free online stock trading company Robinhood is offering retirement accounts. The company will offer IRAs and Roth IRAs, and also said it would pay a 1% match on all contributions made through the program. In other words, for every $100 you deposit, Robinhood will add an extra $1. Scott, do you think this is a good idea by Robinhood?
Well, Robinhood needs to find something here. They were getting about 2/3 of the revenue from commissions on options and cryptocurrencies. So they were saying, hey, it's hysteria, young people who are more risk aggressive have some extra money in there because of stimulus payments. They built a shitty business that wasn't sustainable. And as a result, the stock is off 90%. My prediction is it goes down another 90%. So they need to actually find something that's enduring. And retirement accounts are sticky capital. So this makes sense for them to get into it.
Sorry, what do you mean by sticky capital?
Well, if you open a retirement account, if you trade options on Robinhood and then all of a sudden you realize that AMC is not going to $1,000, or you realize that day trading is a stupid business and that they were lying to you, that it's not investing, it's not learning, it's gambling, the volume is down at Robinhood. As a matter of fact, revenue declined 1% last quarter. So they need to get into a business that's more enduring. If you put $1,000 into a retirement account, Ed, it's likely that $1,000 will stay in that account for a long time. Their transaction revenue was off 22% year on year. They've had a couple rounds of layoffs, and the stock has been cut in half, and it's off, I think, 90% from its high. Anyways, their monthly active users is at 12 million, down from 21 million in Q2 2021, and crypto trading is down 55%. So, look, this is a good idea. Them offering 1% is just a discount. They're just saying we raised a lot of money, so let's try and buy retirement funds and go out and say for $99, we'll give you $100 worth of retirement. This is just pure discounting. Getting to this business is a good idea. They're trying to buy a business. We'll see if it works. If you can set yourself up as the retirement account for young people such as yourself that are about to come into their prime income earning years, it's probably a good idea. The problem with this is it's not enduring, and that is there's nothing differentiated here. It's not very difficult for another financial services company, whether it's Charles Schwab or TD Ameritrade or name your brokerage to offer the same type of discounting. There's nothing enduring here. I think what they're trying to do is take advantage of the fact that they have several million accounts and offer a new product. On the whole, it's probably a good idea.
How much of this do you think is branding? I mean, you're talking about how they were sort of known as this risk aggressive, not investing but trading app, and this is now sort of leaning into, no, we're a safe place to store your assets and for people to buy and hold. Do you think a lot of that is branding, or do you think this is purely financially motivated?
I don't know. I don't think it was a brand move. I think it's essentially their business is collapsing. They took advantage of a bunch of drunk. It was 10 p.m. at 11, the strip club in Miami, and it was a crypto convention on a Friday night, and roll out the champagne and the cocaine, and people are spending like drunken sailors. That doesn't last. That's not an enduring business. And so they've got to come up with something that is more, for lack of a better term, responsible and enduring. This is a company that needs to find a lifeboat as this business doesn't work.
Scott, we're going to listen to your conversation with Aswath in a moment. But first, what have you learned from Aswath? Specifically, what have you learned from him about how to value a company?
So Aswath is very unemotional. That's the thing I love about him, is he can look at a company. Mm-hmm. First off, anyone who wants to learn how Aswath values a company can go to his YouTube channel. It's one of the most viewed YouTube channels in the world for financial advice. His most recent line of thinking is around the life cycle of companies. And one of the more interesting things he's been talking about recently is that, and it's really struck me, is what happens when baby boomers can't come to grips with the fact that they're no longer teenagers. And what he means by that is that what you're seeing in the growth market is all of these cloud-based companies and all of these sort of big tech, high-growth companies are no longer growing, but they refuse to believe that they're aging. And they refuse to return money to shareholders in dividends or in stock buybacks because they believe that they should continue to invest, they continue hiring, even when it's well beyond the fact that, okay, no matter how much Botox you pump into your face, you got to get over it. Every company ages. And so he talks a lot about the life cycle of companies. He also talks about companies that are been over-punished or over-rewarded. So, for example, one of my predictions yesterday in our predictions deck was that I think Meta is going to outperform the markets next year because it has been over-punished, that everybody's assuming not only will Meta lose every dollar they're investing in the metaverse, and that's probably accurate, but they have decided to punish the rest of the business, which is still an amazing business. So I like Aswath because he's kind of like a just the facts man kind of guy. And I think if I've learned anything about him, it's to be unemotional. And I find that my emotions or my affection for a company or my disdain for it unduly affect my emotions. I have confirmation bias. I want to find reasons that Meta stock is going to go down. And after listening to him, I realize it's probably going to go up in 2023.
Okay, with that, here is our lightning round with Aswath Damodaran, the Kirshner Family Chair in Finance Education and Professor of Finance at NYU's Stern School of Business, where he teaches corporate finance and valuation.
Aswath, where does this podcast find you?
In San Diego. Looking out of my window, I see the Pacific Ocean. It's a sunny day, so no complaints here.
You're at home.
Yeah.
So I was saying off mic that you're sort of my secret weapon, and I'm not exaggerating. Every 48 hours, somebody calls me or emails me and says, can you introduce us to Aswath Damodaran? We'd like him on our board, or we would like his advice, or we'd like him on our podcast. And I'm always sort of reticent to give up, to provide the intro. But anyways, Aswath, it's good to have you back. I think you're the first 5 or 6 time guest on the pod. What are your thoughts on Apple's valuation right now?
I think Apple, I own Apple because I think it is the most valuable franchise in the world in the iPhone. But the terrifying thing for me in Apple is I'm buying a smartphone company. I'm not buying a smartphone company that has an ecosystem that it can use to make money through the App Store. But it lives or dies with the smartphone. I mean, I'm terrified if I'm an Apple investor that the next iPhone won't catch on. So among the tech companies, it has the most valuable franchise, but it's also the most concentrated in one product. So that's a plus and minus of Apple. Very valuable franchise, incredibly profitable, but all focused on that one franchise. The thing I find most impressive about Apple is the fact that they've had the discipline not to invest $200 billion in cash. I know people view this as a negative on Apple, but I think of the amount of discipline it must take for a company with $200 billion in cash who can buy whoever, they can buy Netflix, they can buy Disney, to not do any of that. I mean, imagine the number of investment bankers and consultants lined up around one infinity loop saying, hey, we've got exactly what you want. And I think that discipline is what Tim Cook has brought to the company that I think has made Apple the most valuable company in the world. Now, sometimes people complain about companies not investing cash, Berkshire Hathaway and Apple, and sometimes not investing cash is the most difficult thing to do, and these companies have pulled that off.
Thoughts on Iger's return to Disney and Disney's valuation?
It's chaos. I mean, I trace this back to the board of directors at Disney allowing Iger, and in fact, it was both sides were complicit in this, because he was supposed to leave after 2011, and he was supposed to set up a transition plan where in fact, when I taught this in my corporate finance class in 2011, Disney is one of my lab experiments. I said, this is great, a CEO who is planning his own transition.
They
4 years later,
they all cling to power, don't they?
They all cling to power, and the board of directors made him stay on. The bench cleared because Disney had a great bench ready to go when Iger stepped down in 2014 or 15. When he decided to stay on, the bench cleared. So by the time you get to 2020, there was nobody on the bench, which is one reason Bob Chapek became their apparent, because really there was nobody, who's left to take over the company who could. I mean, Alan Bergman is amazing, but he doesn't want to be CEO of Disney. He wants to be a content guy. He wants to be in the movie business. So I think that by doing what he did in 2015 and the board going along with it, Iger set the stage for what we have today, which is a person ill-suited to run Disney coming in as CEO, and essentially over the next 2 years managing to go to war with his own company on almost every dimension. With his content people, with his, with his employees. I mean, in a sense, you could see Chapek wasn't working. And because there's no bench, they had to go back to Iger. This is like, my deciding that, that my center field is not working, so I'm going to call in Bernie Williams to be my center fielder as the Yankees. It was necessary, but I'm not sure what the next step is, because in 2 years, how are you going to find enough of a bench in Disney to take over? So I'd be worried in 2023 that Iger is convinced to stay on another 2 years because they're not quite ready yet. So for the moment, people are celebrating the return of Iger, but I think there's a long-term issue here of who's going to run Disney after Iger leaves. Because you have this uncertainty if you're sitting on the bench saying, will this actually happen? And I think if I were Iger, I would make it a date specific and actually have the board sign off on that date and not back away from it. Because otherwise, we're not going to have anybody ready to go when he decides to step down.
And the broader kind of media space, the streamers, Netflix, and what do you think? It strikes me that all of a sudden, now that Apple, Netflix, and Hulu have all decided to get in the advertising space, that every ad-supported media company is going to come under additional strain. I'd love to get your thoughts on Disney's valuation, and then I don't know if you've looked at it, but Warner Brothers Discovery.
Yeah. I think the problem in the entertainment space is Netflix has broken the space and nobody knows how to fix it. I mean, because for the long
I love that.
And because I think that in a sense, Netflix changed the rules of the game. They said, rather than curate content and then spend money, they said, let's make content and hope something sticks. And for a long time, people at Disney and Warner Brothers looked at Netflix with contempt, saying, these guys make all these shows, most of them are terrible shows. Why would you do something like that? Until they've all decided to join in the game and start producing content like it's going out of style. I mean, Disney's problems can be traced back to how much they're spending on Disney Plus content. I mean, there's no dancing around this. They're throwing I mean, they're doubling how much they're spending on content, hoping that Disney Plus pays off. But Netflix, which is the leader in this field, hasn't figured out how to really make money in the long term from that business model. Why would joining them make the business any easier? In fact, it's going to make it even more difficult. And they can all create ad-supported business models, but they're all going after the same ad money, which is, there's only so much money that you can spend on advertising.
Game, right?
No. And I think that Google and Facebook are going after the same space because they're desperate too. The game has become saturated. There's no growth to cover up weaknesses. So I don't think an ad-supported business model is really going to bail them out here. It's not going to bail Disney out. It's not going to bail Netflix out. They might think it's a salvation, but I don't think it is. I really think that there has to be a way to fix this business before it becomes successful. And maybe you'll need a couple of companies to fail for that to happen. Now, because remember, the airline business has been broken for 50 years and people haven't figured out how to fix it. Sometimes businesses can stay broken for extended periods before people find a way to fix it. But for the moment, the entertainment business is broken, top to bottom.
So
and
even,
I think
even with its 50%, even with its comeback, Netflix has been cut in half. You'd still stay away from it.
Yeah, I don't like I know I describe Netflix as the equivalent of a hamster on a wheel, which is they've trained their users into bad habits. I mean, if I'm a Netflix user, I turn on Netflix, I expect 10 new shows to show up every single day. And not just 10 new shows, 10 new shows that I like. It's almost like I expect Netflix to create content just for me every day. Because that's the way they've built their user base. So I think the problem I have with Netflix is, that's not a business model that in the long term is sustainable, because you have to spend more and more money on content, not just to get new users, but to keep existing users on. So Netflix is the one Fangam stock that I don't own. I own the remaining 5. It's the first time in my life I've owned 5 of the 6. But Netflix is the one stock that I've steered away from because I just don't like the business model.
So Warner Brothers Discovery, $50 billion in debt. The equity component of its enterprise value has been cut in half. What do you think of the prospects there? Would you get near the equity? Is that a restructuring?
I think that's due for a restructuring too. I mean, I think it looks cheap on all the conventional bases, but I think that this might be one of those value traps where you get in and it can make a small recovery, but you're going to keep falling back. I think that debt acts as a constraint on their ambitions, on the things they can or cannot do. So it's almost like you want to reinvent the space, but you can't reinvent it if you bring $50 billion to the game in debt, because those lenders are going to veto some of the things you might plan to do. There's just too much money at stake.
So my biggest holdings were Amazon and Apple till last year, and I needed some liquidity. I was buying a home in London, so I had to sell one, and I made the wrong choice. I sold Apple, and I still hold Amazon, which has gotten, Apple's held up remarkably well. Amazon has not. What are your thoughts on Amazon?
I think Amazon has gone through these cycles over its 25-year history. I think that it's almost like people go from never questioning Amazon to questioning them on every dimension. So right now the big issue is, will they ever make money again? If you look at every business other than the cloud business, because all of a sudden people magically discover that the margins outside of the cloud business are about half the margins that everybody else gains in that business. I mean, I still believe that they will. I've looked at at how that business has changed over the last 25 years. They used to lose money. They've at least started to make money on Amazon Prime, net of the shipping costs. So I think they're moving in the right direction. They're not moving at the speed I'd like them to. So I think Amazon is cheap at their $800-900 billion market cap. But I think that you're going to have. And again, they're a company that knows how to load up bad earnings report with all the bad news. So in many ways, what you saw in their earnings report was they're dumping everything that they wanted to reveal to the markets into one earnings report. Say, hey, respond to this, guys, because it allows us to bring expectations down. Maybe I'm attributing too much power to them, but they're masterful at bringing expectations down and then beating them in future periods. And I have a feeling you're going to see some very positive earnings reports from Amazon, at least relative to analyst expectations.
At some point, does it become an activist play? What if they spun AWS?
It might. But I think for the moment, I don't think it's just, these companies, it's so difficult for an activist to throw their weight around and actually create change. Carl Icahn tried with Apple a decade ago when it was a much smaller company, and you realize, when you got a $200 billion company, unless you can get other institutional investors to join in your pursuit in large numbers, you're not going to pull it off. With Amazon, I think it's going to be tough to find that mix of institutional investors, because for activist plays to work, you got to get a general acceptance that management is not competent. So you can get an activist play at Facebook. The only thing is, how do you you don't have the voting rights to make change. But I don't think you're going to get the activist play yet at Amazon, because I think Andy Jassy has created enough of at least an aura of, hey, I know what I'm doing, I'm pretty competent, for that to be not an issue right now. But it could happen if you continue to see another year of a 50% drop in market cap and other experiments. Right now I've heard about the Alexa experiment not working out. I'm hearing an awful lot about Amazon experiments not working out in the last few months, even though these have been experiments that have been going on for a while. If those stories become louder and the market cap continues to drop, perhaps because, there are no protective guardrails at Amazon against activists taking a position. And I don't think Jeff Bezos is going to be, throwing his weight too much around in the company. So it is potentially an activist play in the future.
And stocks that feel, by most traditional metrics, cheap right now, Chinese stocks. What do you think of Alibaba and Tencent? Do you think there's opportunity there? If
you're willing to have Beijing in your room as part of the story. That's the reality with Chinese companies, is Beijing is always part of your story. And the problem with Beijing being part of your story is it's completely unpredictable, and it can make good stories bad overnight. So, I think Alibaba and Tencent look incredibly cheap on any traditional metric. But the reality is, if Beijing decides that they're not cheap enough, it could make them even cheaper. So I think for a long time, we actually gave premiums to Chinese stocks because we thought the government was in the room with them. Didi was given a premium valuation because the assumption was, hey, the Chinese government is on their side. They can keep Uber out. And they were right. They did keep Uber out. But now the Chinese government is in the room. They seem to have a different agenda than Didi has about what the future should bring. And all of a sudden, investors are waking up to it. So it is a reality that you have to accept. And if you are okay with Beijing being part of your story, and you think that eventually Beijing is going to find a way to make the story a good one, then by all means invest in Chinese companies. But if you're uncomfortable with governments throwing their weight around and altering your story, stay away from Chinese companies, no matter how cheap they look.
What does look cheap to you? Where do you see opportunity in the market right now?
As I said, I bought into big tech because I have a feeling that big tech is being marked down way too much. I understand why people are down on it. And I could be completely wrong about this. A year from now, I wish I hadn't put my money in those big tech companies. So I think big tech is, I think if you bought a portfolio of companies like Peloton, Uber, which have been punished a lot, I think you're okay, but don't put your money in any one of them, because any one of them, disaster could strike. But a portfolio of young tech companies which have, hit hard times, I think that the upside that you might get in that portfolio is a good one. So I think there's a lot of potential in tech, especially, that has been marked down a lot over the last year. Among the markets, I think geographically, if you look at markets, I think China looks cheap if you're willing to accept the Chinese government. But U.S. stocks have held up surprisingly well, given how much risk premiums and risk-free rates have gone up this year. I think that my implicit cost of equity for U.S. stocks has increased by the most I've ever computed in a single year. In the 40 years that I've been tracking that number, it's gone up from about 5.5% to almost 9% during the course of this year. And if you told me at the start of this year that your required return on equities is going to go from 5.5% to 9%, what do you think will happen to stocks? My answer would have been about a 30% drop in stock prices. And we haven't seen that. So in many ways, I think stocks have been resilient given what's been happening in the macro environment. Now, next year, of course, is going to bring the test of a recession and whether inflation stays on. But I think that now collectively, stocks have held up remarkably well this year.
And when you look at, I think of it, it feels like for the first time, bondholders are getting some return or getting rewarded a little bit around some of the risks that they've taken. I've been on the boards of a bunch of companies the last 15 years, and I always said, even if we don't need it, issue debt, because I can't get over the fact that we can borrow money for 3%. It just felt like, why on earth would people loan us money at these rates? So take it while we can. What do you, in terms of the market's moves and interest rates over the last 12 or 24 months, how should people be thinking about their portfolio allocation?
Well, new bondholders are really being rewarded. Old bondholders are being hammered. I think this has been perhaps the worst year for government bond and corporate bondholders in a long time. Because as interest rates have gone up, prices of bonds have collapsed by levels I don't think I've seen in a really long time. But I think finally, if you're lending money, if you're investing for the first time in bonds, you're getting a rate of return. You look and say, I could live with that. For the longest time, I looked at bond rates and said, I'm not investing at a 1% coupon rate for the next 30 years. It doesn't make any sense to me. In fact, in hindsight, you look and say, why did we ever settle for that? And you're right, because rates were so low, companies said, hey, and I'm surprised that more companies didn't borrow more, to be quite honest. Lock in those rates for the long term. Surprising number of companies have short-term borrowing that they took at the low rates, which actually gives them very little benefit, because when that debt gets rolled over, you either have to replace with equity or with much higher rates. So, but I think the same thing could be said about individuals who didn't lock in 30-year mortgage rates at 1.5, 1.7%, because that might have been the best financial decision you could have made in hindsight over the last 4, 5, 6 years. But I think that we're getting back to a steady state. I think that the last decade was the aberration, because in a sense, 2011 through 2020, if you look at it relative to financial market history, was the strangest decade that you could have lived through as an investor, as a lender. So rather than think of things as being unusual now, really this is a return to normalcy. A 7% mortgage rate might strike you as insanely high if you're 25 or 30 years old, but I look at a 7% mortgage rate and said, hey, that's what I borrowed at 30 years ago. So in a sense, for the longest time, 6-7% mortgage rates were steady state. So I think we're returning back to some degree of normalcy with interest rates, and that's a healthy thing in my view.
Yeah, I remember in college, and a friend called me and said we should scrape together money to buy a house because mortgage rates are now below 10%, and he felt that was cheap. Any thoughts on what's happened in the crypto market? Are we getting towards the bottom of the delevering, or is it just going to get worse from here?
You know what? I think the crypto market needs to be cleansed of its strongest advocates. To me, the weakest link in the crypto market are all the people who speak up for crypto, because they tell the most awful stories about why I should be investing in crypto. Starting with it's scarce, therefore it should go up. That's an incredibly lazy rationale for investing in something that it's scarce. So I think I think that this is long overdue, because I think people have been investing on a hope and a prayer in this market, because there's been no tangible movement among cryptos in actually filling needs that we might need in markets as a currency that you use in transactions, as a collectible that holds up value. So I think there's going to be a lot of cleaning up here. Whether it goes to zero or not, I don't know. But I think we're going to test lows that we didn't think we would test. Because Bitcoin has been priced through its entire lifetime, and when you price something, there's no upper bound or lower bound for the price. We've tested the upper bounds, $50,000, $60,000, $70,000 for Bitcoin. We could test the lower bounds, which is zero.
So you don't buy Cathie Wood's statement that crypto comes out of this or Bitcoin comes out of this smelling like a rose, and she has a price target of 1 million in 2030?
I'm not sure whether Kathy says these things because it gets her attention or whether she truly believes them, because either way, I worry, because if she actually believes them, I think that the definition of insanity is you do the same thing over and over again expecting a different outcome. She seems to try this out in every single one of her investments. But I think a lot of this is it gets her attention, which doesn't seem to hurt her, because there are still people who invest in ARK in spite of its track record.
She's had inflows. She's had capital inflows this year.
And so maybe it as a sales pitch, maybe it's good to be hyperbolic in your forecasts and throw out these numbers that are outlandishly high, because people pick up on it. It gets picked up not just on CNBC but in social media, and that doesn't seem to hurt business.
So this might be a question for our colleague David Yermak, but I look at FTX and I wonder, okay, why wouldn't the same thing eventually play out with Binance? Have you looked at Binance?
Yeah, I can't come up with a good reason why not. You've got these self-regulated, essentially they're playing the role of either exchanges or banks with no regulation on them. You're just taking them at trust. And I think that's a very dangerous commodity to base your investing in. So I don't know enough about Binance to claim that it's going to go the same route as FTX, but I worry about the lack of transparency in every single one of these entities. And with the lack of transparency, I'm setting myself for all kinds of surprises down the road, which are potentially going to be negative surprises.
Aswath Damodaran holds the Kirchner Family Chair in Finance Education and is Professor of Finance at NYU Stern School of Business, where he teaches corporate finance and valuation. He's written extensively on valuation, corporate finance, and portfolio management, and his blog, Musings on Markets, was selected by the Times of London as one of the top 10 stock market blogs in the world. And most importantly, he has been voted Professor of the Year across 190 faculty by the graduating MBA class 9 times during his career at NYU. He joins us from his home in San Diego. As always, Aswath, really appreciate your time.
Thanks, Scott.
For more from Aswath, check out the December 1st episode of the Prof G Pod, where he and Scott talked about Twitter, Meta, and the economic outlook. For now, let's take a look at the week ahead. We'll see inflation data for November on Tuesday, and the Fed will deliver its last interest rate hike of the year on Wednesday. The only question is whether it will be 50 basis points or the fifth 75 basis point hike in a row. Scott, do you have any predictions for us?
So my prediction is that Disney is going to make a big acquisition in the first half of 2023. I think Bob Iger, at the age of, I think he's 71, has just come back. I have no idea why he decided to come back. He sort of rang the bell at the high. But I think he's got to do something big. And I think the ad-supported media ecosystem is under attack, and he needs to do something kind of big and bold. And also, he has the license and credibility to do it. He didn't come back to just sort of manage the company slowly downward. And I think there's an outside chance that he makes a big acquisition like Roblox. And my thinking here is that just as they've made a lot of really deft acquisitions where they could suck the IP or the characters, whether it's The Mandalorian or, Woody and Buzz Lightyear, and those are Lucasfilm and Pixar acquisitions respectively. I think if they were to acquire Roblox, which has seen its stock, like every other company, get hammered pretty severely, it's now got about, I think, an $18 billion market cap, they could push Disney parks to Roblox. They could create the Disneyverse. 50% or more than half of kids in the U.S. under the age of 18 are on Roblox. And I think the idea of taking the parks and some of that imagination and joy and characters out to, or disperse it out to the Roblox community, if you will, would be an interesting idea. And I think Disney has about $160 or $180 billion market cap. They'd have to pay 25. So it'd be a 10 or 15% dilution, which would be a huge acquisition, but it wouldn't be a Bet the Ranch acquisition. And if Disney were to say, all right, we're the leader in intellectual property and media for kids and family, and we have this unbelievable parks business, and we've also moved the parks business into, quote unquote, the Disney verse via Roblox, and we're bringing up an entire generation of Disney fans with our characters that we've sent on a kind of a world tour of different Roblox games. I like that type of acquisition. Anyways, my prediction is that Disney is going to make a pretty big acquisition in the first half of 2023. That's all for this episode. Our producers are Claire Miller and Jason Staver. Special thanks to Catherine Dillon, Ed Elson, Mia Silverio, and the Prof G Media team. If you like what you heard, please follow, download, and subscribe. Thank you for listening to Prof G Markets from the Vox Media Podcast Network. We will catch you next week.